Hello, everybody. Welcome back to Bitcoin and Markets. My name is Ansel Lindner. Happy Wednesday out there. We do have CPI coming up tomorrow morning, so I will be live streaming that. I just wanted to get a episode out today. I want to react to what's going on with the price, go over some of the ETF flows, things like that. And then I wanted to take a look at a couple videos and react. So one will be of Jeff Booth, who is a fellow deflationist in the Bitcoin space. And then George Gammon, who I have watched off and on for a long time, less so recently, but he seems to be coming around on a lot of his thoughts, becoming more similar to my school of thought. So I thought we'd watch through that and I'll comment throughout. Let's share the screen and get into it. Bitcoinandmarkets.com. This is where you go to subscribe to get all of my written content. If you're watching on YouTube and Rumble, like, comment, subscribe, and I will get to the comments later on. Let me maximize this for Telegram. All right, so where are we going first? Let's go to price. Here is the daily. This is with the 200-day moving average and the 20-day moving average. There, we're coming into this cross. If we go back to the last time this happened, that was August, I think, of 20. You can see back here, price jumped into this cross. And let me bring up the 50-day moving average because that might tell us something different as well. My computer is running slow right now. So that cross didn't happen till out here. But right here, you can see that the 20 and the 200-day, we rallied into that cross. Then we went sideways for a significant period of time, a couple months, before breaking out. I don't think that's going to really happen this time. I think we're going to have a faster bounce to the upside, but of course that remains to be seen. Price getting rejected off the 200-day, as well as the top of this formation. If we go down to the 4-hour, we can see this and get rid of these moving averages. You can see we tried to break up, but we were rejected by that 200-day moving average, and now we're back below this red line. And now if I go back to the daily, you can see that is from the close back on July 6th. So watching this, I think we have a chance to bounce. I wrote a lot about this yesterday on Bitcoin Magazine Pro. Check that out. And so what else? Let's take a look at some other things. Of course, all this selling pressure people have been talking about, the German government. It turns out to be a state government of Saxony, a former East German state. And they are selling off this Bitcoin, not the larger federal government of Germany. But all the sell pressure is supposed to be just Bitcoin, right? Mt. Gox, just Bitcoin. Germany, just Bitcoin. Well, then how come Ethereum is also tanking? Ethereum, if we look here over the last day here, it is back higher a little bit. But overall, over the last couple weeks, it is down against Bitcoin. I did measure this out, and this move from this high here on 1 July to the bottom for Ethereum was negative 20%, but for Bitcoin, it was only negative 16%. So, Bitcoin is outperforming Ethereum, even though all this sell pressure is just for Bitcoin. If you measure from the high over the last couple months, Ethereum was down 31% and Bitcoin was only down 27%. So again, supposedly there is all this sell pressure on Bitcoin, but Ethereum is the one that is performing worse. And you can see this thing I have right here, that the ETH ETF rule change was accepted right here, and the price has been pretty much down ever since. All right, let's take a look at the dollar. Just a couple macro stuff. On the day, the dollar is down, still weaving in this pattern, this consolidation flag. We will see which way it breaks. How about the JPY? Because it was going higher again today. So the JPY, you can see, is trying to break out to fresh highs, or this would be the JPY is depreciating versus the dollar. The dollar is getting stronger. The yen is getting weaker. And it looks like that is going to continue. And while we're at it, let's take a look at the Chinese yuan, and it also is breaking up. Now, I think this overall, okay, someone's going to make a comment about my axis here, so I'm going to fix that. Let's do 2 decimals. All right. So I think the pressure on the yuan, on the yen, is actually coming from the yuan, and we can see that with the crash in their government bond yields, signaling a rush to safety, and they can't actually do deficit spending, significant deficit spending. They have to borrow these their own government bonds and sell them back out into the market to try to fight this crash in their yields. The reason why they can't do deficit spending is because of this. The yuan is extremely weak. I think there is some major economic fallout that's about to happen from China. And since Japan is so closely linked, I think it's affecting the Japanese currency as well. All right. How about the US 10-year? I haven't looked at these today, guys. So right on this midline of this channel coming down, nothing very significant to report here. Remember, as rates fall, that is that's where people are trying to rush into safety, or they are experiencing, or they are expecting lower growth and inflation expectations in the future. So, and we will be covering that when we listen to the George Gammon clip. How about oil? Oil is up on the day, but still down from recent highs, recent swing highs. We'll see if it can break up from here or down. Of course, overall, over the next several years, I think the oil price will trend lower. And stocks. Stocks are just shooting up to new all-time highs, and this matches with a lot of what I've been saying as well. Stocks are kind of seen as a savings vehicle. I mean, what do you do if you cut down some of your discretionary spending to save more? You're going to put it into your 401ks or your retirement plans or whatever the case is, and it is going to go directly into these stocks. And a lot of times the passive investing will be apportioned by the share of market cap for that index. So if NVIDIA is the largest stock, then it will get most of the passive inflows. If you're just investing in an index fund, that's why the large stocks are outperforming everything else, because people are pulling back their belt or tightening their belt, and they are putting more money into retirement and stuff. So anyway, this is what we should expect. I did have an interesting tweet here. Let's share this tab. This is from yesterday's Bitcoin Magazine Pro article, and let me bring up this chart. And this is the NASDAQ versus Bitcoin. And you can see this period back in 2019 was a divergence. Bitcoin was going down while the NASDAQ was going up. Very similar to what we see here today. And what happened? Bitcoin turned around and caught up to the stock market. There are other periods like this one here in late 2020. However, directionally, Bitcoin was still rising along with the NASDAQ. So that is not a decoupling. It's just kind of an increasing spread, I guess. And then over here, same thing. Bitcoin was flat. It did not make new lows here in the second half. And so it was flat and not directionally decoupled from the stock market. So that's different than these two periods that I highlighted here. There is another one right in here where Bitcoin is dropping while the stock market is racing. And what happened? Bitcoin did turn around and catch back up to the stock market. So that's what I expect to happen here. And I will also share, did I tweet that out today? Let's see. Let's see if I tweeted that out. Yes, I did. And here is a picture of the S&P 500. And on the bottom here, this is the percent of the stocks in the S&P 500 that are above their 50-day moving average. I highlighted the bottoms, and those occur below 10%. So when fewer than 10% or fewer of the stocks in the S&P 500, when they are, or I should say, when 90% of the stocks in the S&P 500 are below their 50-day moving average, then that is most likely a bottom, or at least very, very close to it. You can see we did have like kind of a double bottom here back in mid 2020, where the second low was slightly lower, but it did have the rally in between. Anyway, we are very close to a bottom when we experience those down here. But with the tops, I went through and checked out where all the tops occurred, and I didn't highlight this one, but they all occur above the 50% line, okay? They all occur above the 50% line, and significantly in some cases. So here, we don't have that, okay? We are actually below the 50% of S&P 500 stocks above their 50-day moving average. So we're not really in danger of topping at this point for the S&P 500. This will have to go positive, and probably significantly positive, before we need to be worried about a top in the stock market. So if that is the case, and we think back to this image of, this is the NASDAQ, not the S&P 500, but if we think back to this, stock market will probably keep going, and Bitcoin will turn around and catch up. Okay, so I hope that makes sense. I hope you guys are tracking on that. The other image that I wanted to share was this one. Again, you guys can find these on all the stuff I write at bitcoinandmarkets.com. These are the Bitcoin ETF flows up through yesterday. You can see yesterday was over 200 million. So two $200 million days, $200 million days this week. Friday was also quite positive. So this is looking good in the face of course, all that selling from Germany. Mt. Gox has not really released very many coins. I think they're up to 2,700 coins that they have released to Japanese exchanges. I don't think they've released them to anywhere else, but I will be watching that Mt. Gox stuff and reporting on that. But this is interesting for ETF flows. Okay, we'll see what they come out to be today. All right, that's it on that. Let's jump into this clip of Jeff Booth, well, before I do that, let me see if there's any comments here. Let's see, my stream is going out. This happened yesterday too. Like when I'm streaming, there's usually a significant amount of people that are watching, and this is like, it's not even showing as if in this corner, it's not even showing as if I'm going out, which is crazy. So hopefully it's working. Let me check Telegram. Can you guys one of you guys run from Telegram over to Rumble or YouTube and see if I get a populated number here? For some reason, it looks like either I'm being shadow banned or what. I've already lost one YouTube channel, so I need to self-censor a little bit here. But anyway, we will get that figured out. Okay, let's get on with this. Simply Bitcoin, Jeff Booth, deflationist in Bitcoin. I'm a deflationist in Bitcoin. However, okay, Sterling says looking good. Thanks, man. But I'm not seeing my numbers of viewers for some reason. I'm seeing the comment. But okay, let's get back to it. Jeff Booth, deflationist. I'm a deflationist, except I'm a monetary deflationist. I care about the money supply, where he cares about prices. And this is going to become very clear when we watch through this. And I will pause it and comment throughout. So let's make this bigger. Can we do that? Nope, that didn't work. How do I make this bigger? This one. Okay. And we're full up. Let's go.
Just keep saying, like, over and over and over again, the natural state of the free market is deflation. And once you understand that, then you understand everything else is stopping it. And if you think your prices are going up, and if you think this politician and this is going to be growth, like, listen to politicians talk about growth today. They're talking about their productivity growth is faster deflation. So what they're actually talking about is, we're going to manipulate money faster to steal more money from you.
Mm-hmm. Okay. So what was this first line there? That deflation, free market is deflation. Let's go back and listen to that exact phrase.
Is deflation.
Okay, what?
Yeah, like over and over and over again. The natural state of the free market is deflation.
Okay. What he means there is price deflation, which price deflation is not actual deflation. It's just prices falling, and prices can fall for many reasons. They can rise for many reasons. Now he uses the period of the classic gold standard as saying, okay, look, we're under the classic gold standard, free market, we chose that type of money, and we had gently falling prices. But I'm going to blow up his entire argument here in just one point. During that time, there was actual inflation. The amount of gold increased. It increased dramatically between the start of the classical gold standard and the end. There was massive amounts of inflation, 1% to 2% a year. There was actually more gold in the system every year. And some periods, there was a lot more gold. So under that circumstance, when we have inflation and prices are gently falling, see, this is why I say a lot of times, you cannot use prices to judge whether something is inflation or deflation, because prices, and they move for a lot of reasons. So, his idea that the free market, the natural state of the free market is deflation, is wrong. Okay, let's continue.
And once you understand that, then you understand everything else is stopping it. And if you think your prices are going up, and if you think this politician and this is going to be growth, like, listen to politicians talk about growth today. They're talking about their productivity growth is faster deflation. So what they're actually talking about is, we're going to manipulate money faster to steal more money from you. Mm-hmm.
Productivity growth is faster deflation. Well, productivity growth has to be financed, right? And so normally you would finance increases in productivity growth through credit, and expansion of credit is actually inflation. So there again, you're talking about inflation leading to productivity growth, leading to lower prices. That's why you cannot talk about inflation and deflation from a price perspective.
They're not talking about growth at all. So just keep going. The natural state of the free market is deflation.
No, it's
and
not.
Everything that stops it is not a political system. It's not an economic system. It's a control system. And it's so critical. Now, why that's important in AI is, as AI moves faster and faster, which it inevitably will, exponentially, and it merges with robots that can do anything that you can do way better, faster. The business that hires that brings in robots that you say you won't use because they're removing labor, you will use because it's cheaper for you. You will use it.
Okay, I had a comment on this on Telegram yesterday when I posted this video originally, and I asked him back when I interviewed him a couple years back for FedWatch, if people would choose higher cost option for a different reason, a higher level reason. So, for example, would I choose to buy a made in the USA and pay 25% more for that product because it's made in the USA? And he said, no, people would not do that. That's not how it works. You always go for the lowest cost. And this is what he's saying here as well. You always go for the lowest cost. Well, what about organic food? People pay higher prices for food that they think is organic. They do. You can find this in every single sector, every single industry. Okay, it's where you place your product. Some products are the low cost products. Some are the medium cost products that are a little bit higher quality, and some are the higher, they're positioned as the higher quality at a higher price, and people still buy them. So it's not true that people will always pay or always go with the lowest cost option. It's just not true. And as we go into a period of deglobalization and a rise of nationalism, patriotism, and um, uh, populism, people will naturally choose the higher cost options. Naturally. I mean, you can think of this like an immigration thing where um, you do you want this low cost labor to come in? Most people now, at least in the United States and probably in the West and all over the world, Japan and China, and everyone pretty much agrees that no, you don't just want unmitigated low cost labor coming into your country. So you're willing to pay, the concept is you pay your own citizens more money, higher wages for the same job. So of course, people will choose higher cost things. Okay, and he also is talking about AI and robotics being like an exponential nonstop function higher. Well, that is not going to be the case. We live in a scarce world, a world of trade-offs and scarcity, and you can't just have exponential growth. That's why a lot of people who make, he's making an exponential argument on the good side, like we're going to go to utopia with exponential growth. But most people use exponentials as a doom thing, like things are going to keep getting worse and worse and worse exponentially, and the wheels are going to fall off. I'm thinking of Luke Gromen and others that talk like this. They just have a linear mindset that they don't understand the complexity of different things going on, the interplay between industries, the interplay between producers and consumers, the interplay between the free market and governments. And so Jeff's idea here of exponential AI and robotics is not going to happen. It's not going to happen, especially if we are going into a period of extended economic malaise and decline, which I think we are. It's not going to be profitable. So I've shared many articles on Telegram about the cost of AI and how the cost of AI is also exponential. If you are, you say that the speed and the learning and the profitability of AI or whatever is exponential, well, so is the cost. And so you're going to reach a point where you simply can't afford, the trade-offs are too high to trade off to run AI in your business or whatever. Right now, we're in this bubble where everything is trying out AI. But in the future, we're going to run up against these costs, the limitations, the natural trade-offs in economy. And so that's what I have to say about that. Okay, let's continue.
And if a business doesn't use that, they will go broke because you will choose differently. So if your choices are driving this to lower and lower prices, shouldn't you benefit in an economic system that is repricing that and sharing that abundance with all people on Earth. That's what Bitcoin is doing. So Bitcoin is, and it just, if you just took kind of $900 trillion balance sheet, which is the world's balance sheet today, and there's 21 million Bitcoin.
I'm not sure exactly where he's getting that 900 trillion. I've seen different measurements of including the shadow banking system of 500 trillion, but that's pretty like all of that will not be transferred into Bitcoin value. You know, as things collapse or as Bitcoin takes over, some of that value of those shadow banking assets will be wiped to zero. So that's the ballpark I would go into. Less than 500,000. I don't know where he gets 900 or 500 trillion. Sorry if I said that wrong. I don't know where he's getting the 900 trillion.
Then the implied value, as long as it stays decentralized and secure, of Bitcoin is about $43 million per Bitcoin today. But that $900 trillion, because you just 900 trillion divided by 21 million.
So half of that go to 20 million as the top. If you're using the $500 trillion assets that I was using or less. So anywhere between say 5 and probably 15 million is like if Bitcoin were fully monetized today, it would be between 5 and 15 million. That's my estimation. And then in the future, of course, if there is higher prices, you know, and things like that, depreciation in the dollar, it could be a lot higher nominally, right? But in today's purchasing power, between 5 and 15 million.
All it has to do is stay decentralized and secure for in time that to be true. It's repricing the other system. But $900 trillion balance sheet today has $400 trillion of debt against it. And that debt is already insolvent. And if it was actually marked to market, the balance sheet of the world wouldn't be 900 trillion. You'd have a cascading collapse.
Okay, there you go. I agree with that.
All real estate prices, banks would fail, everything would collapse. Mm-hmm. So the only reason it's 900 trillion.
Well, it would also trigger a deflationary spiral, right? So as credit collapses, think of the business cycle. And I've been writing my macro thesis on the website, bitcoinmarkets.com. So be subscribed to get that. But it's you know, a typical boom bust cycle is credit driven. And what happens at the end of the bust, it's not inflationary. It's not inflation. It's actually deflation. That credit money goes away. The fiduciary media gets burned. And so if you market to market, and I mean, I don't even know what that means in a credit-based system, in a debt-based system, marketing stuff to market. But if you were to do that and you had a cascading failure like he's talking about, that's a deflationary event. It's a hyper deflationary event. Okay.
And essentially what you're measuring the world through, and you're part of that ledger. The only reason it's 900 trillion is because you think the debt is solvent, and you will vote for somebody who manipulates money instead of allowing a collapse. What does that?
This is giving a little bit too much benefit to central planners. I mean, central planning doesn't work. It can appear to work during short periods of time, but central planning does not work. So it's not like you're going to vote for somebody to do this or that. The economy is going to evolve the way the economy is going to evolve. And you can try to do psychological operations to extend a certain thing in the economy. That's what the Fed does. Okay. They try to create this myth around the economy to have a self-perpetuating, to manifest that into the future. And but it's not as Jeff Booth says here, where you're going to vote for somebody to extend and pretend. The economy is going to extend and pretend. It's going to do what it's going to do, regardless of who's in charge. There is no one in charge. And we'll get to this when we get to George Gammon's piece here in a second. But this is like, I mean, I used to believe in this. I used to be a hardcore gold bug, thinking that the whole thing is manipulated, thinking that the Fed was just an evil money printer. And that's not how the world works. That's not how the monetary system works right now. It's based off of evolution, okay? That some periods, some environments are going to be harsher than others. And then some environments are going to be better than others to have credit flourish, to have the economy grow. We've been going through a period of 75 years where it's been generally good for credit to grow. Now we're going to go into a period, an environment, economic and political environment where it is very hard for credit to grow. It's most likely going to collapse or crash. Maybe not totally collapse, but this is just the natural evolution of a market. This is directly following on from Hayek, okay? And even Mises talked about credit money. He talked about three forms of money. He talked about commodity money, fiat money, and credit money. And he clearly just put the distinction there. Let me pull this up. So for people that are, this is what I'm writing here, this macro thesis, but let me go up to where I quote Mises. We may give the name commodity money, and this is from the Theory of Money and Credit. So his big opus in 1912. We may give the name credit money to that sort of money that is at the same time a commercial commodity, and the name fiat money to money that comprises things with a special legal qualification. A third category may be called credit money, this being that sort of money which constitutes a claim against any physical or legal person, but these claims must not be both payable on demand and absolutely secure. If they were, there could be no difference between their value and that of the sum of money to which they referred, and they could not be subjected to an independent process of valuation on the part of those who dealt with them. Okay, so he's obviously talking about three forms of money. People say we have credit money. People know what commodity money is. That's gold and silver and Bitcoin. We don't have fiat money today. We have credit money. And Mises would agree with me. All right, let's get back to Mr. Booth.
That mean? That means probably 4 or 5 years from now, the $900 trillion balance sheet won't be 900 trillion. It would be 2 quadrillion. And then if Bitcoin versus that balance sheet and the cost of living from there was 90 million terminal value of Bitcoin, it would be the same purchasing power, right? But the more important part is what I'll say here. Prices fall forever. So relative to Bitcoin, your $43 million purchasing power and terminal value today buys more and more forever, because prices will fall relative to it forever.
Okay, so this is an interesting point, and I've talked about this in the past as well, that with Bitcoin having a fixed supply, that the price of things will fall forever versus Bitcoin, or it will appreciate forever with the expanding. So let's just say that global economy is running on Bitcoin or has Bitcoin as its monetary standard, and it grows at 3 to 5% a year, then the value of Bitcoin must expand by 3 to 5% a year as well. So there is no top to Bitcoin. That would be the risk-free rate. You would just hold Bitcoin. You wouldn't have to invest anything, and you would get 3 to 5% return every year by just holding Bitcoin. And I don't know if that's the case anymore, because that the gold standard, where we had gently falling prices because we had gently increasing productivity, took place in an inflationary environment of 1 to 2% inflation. And so we don't know how the economy will react to having a purely fixed supply. And it won't be a purely fixed supply practically. I mean, in reality, it will be. Technically, it will be, but practically, there will be credit on top of Bitcoin. And so the Bitcoin will be able to expand and contract. Now, what's the growth rate? With gold, and you had a 1 to 2% inflation rate, you had gently falling prices because you could have growth at 2, 3, 4%. But when you have no inflation and you have a totally fixed supply, what does that do to the average growth rate of the economy? I don't know. Maybe it goes down to 1%. You have a fixed supply, maybe growth is at 1%, maybe 2%. And that's not very, I mean, it's good that you can just hold Bitcoin. But it's not going to feel like a booming economy or anything of the sort. It's going to be just staying put. And in that period, in that type of environment, you're not going to be able to afford these high cost AIs. Okay. So it's not a rosy picture. When I got into Bitcoin, I thought that Bitcoin was going to bring about this rosy picture, but Bitcoin probably won't. It's going to take a long period of time. And especially when you think about demographics. Okay, this whole demographic decline that we're going through is going to take 100, 200 years to get through. We will be on Bitcoin standard through that. Okay, and maybe you can talk about the decline of population, and then you divide the amount of Bitcoin by the population, then you're actually going to be going up in the amount of Bitcoin you hold, right? Like Bitcoin divided by the total population is going to be going higher as the population goes down. So that's an argument there too. I haven't thought through that, but it's going to be tough for the next 100, 200 years, and then it will lead us to a rosier picture on the back end of this demographic decline. And in that period, okay, so if we think about the evolution of money and the evolution of the economy, Bitcoin will be adapted for this certain period of time, and it will be chosen. But if we go 200 years in the future, and now somehow global trust comes back, somehow we have a new technological breakthroughs, paradigm shifts in science, and we have this fertile soil coming back, we're probably going to pick an elastic money, some sort of elastic money. And we're probably Bitcoin is going to lose its top spot as the global reserve currency. But until then, to get from here to there over the next 200 years, I think Bitcoin is the solution. So anyway, that was a long thing. This is enough of this one. Let's go on to George Gammon, because it's a little bit longer piece. And I'm starting at minute 14:22. He live streamed this yesterday, and I am going to speed this up just a little bit because he's kind of a slow talker. But let's get into this one.
So anyway, Moody goes on to say, if unemployment trends upward, you must act immediately. And she's telling this to Powell, to protect American jobs. Workers have too much to lose if the Fed overshoots inflation target and causes a completely unnecessary recession. So again, the Fed, you got to get it right. Oh my goodness gracious. Holy cow. If you just go up to 5.2 and the correct number is 5, then the whole economy is going to implode because you control everything, Fed. And if you undershoot and go to 1% as opposed to 1.25%, oh my gosh, then inflation, we're going to go straight back to the 1970s because we know you control everything. And
okay, I didn't give this intro. George Gammon, I've been watching him off and on for a while, less so lately, but he has been coming around quite well to the state of the system, grasping what's going on with the system. And I don't have a perfect grasp. I think Jeff Schneider has the best grasp out of people that that I know or that I follow. And so George Gammon is good friends with Jeff Schneider. So he's starting to come around to understand that the Fed is not in charge, that the system doesn't work like we're told it works. The Fed doesn't print money, yada, yada, yada. Okay. And interest rates don't work the way people think. Like higher rates aren't tightening, lower rates aren't loosening. It's actually the opposite of that. And so he's starting to come around, and I thought this was a good clip to get into. His buddy, Jeff Schneider, who I credit for a lot of me questioning my own assumptions about things. Jeff Schneider is probably the premier guy in this Eurodollar system, but he has not connected the dots to an evolutionary thing towards Bitcoin. So that's where I differ from Jeff Schneider. Is I see this as an evolution. He sees this as, again, like Jeff Booth, how they think linearly, like it's from here to the stars. And we're just going to continue to get better technology. We're going to continue to advance forward. And what we have today is like the pinnacle of achievement of all humankind, anywhere, everywhere. And there's no better than this. The only thing that we can go to is an incremental improvement on the current system. That's how Jeff kind of sees this, as far as I understand his position. Of course, that's not the case. Every era, every environment that we go into is going to be different, and it's going to different forms of money, different types of technology are going to fit that era better than other times. So in an era where we had very high global trust after World War II, the West was united against the Soviet Union. The West, the U.S. seemed to be somewhat of a benevolent hegemon, because we didn't take over Japan or Europe. We actually helped rebuild those countries. And usually in war, if you win, you take over. We did not do that. We actually let them form their governments, and we helped rebuild those countries. And so that produced an environment of very high trust, at least in the West. And then post the fall of the Soviet Union, we had this period of global trust, after 91. And that's when credit could expand and yada, yada, yada. Now we are on the tail end of that. We're losing trust in the world. Credit is not going to be expanding. We have falling demographics, where during that previous period, we had rising demographics. And so all of this is a different environment. And some characteristics that make money fit for purpose during one period, you go into a different environment and it's no longer fit for purpose. And that's what we're experiencing with the credit-based dollar. Okay, we're going to go back into a system where the commodity money is what's fit for purpose. And so and the best commodity money is Bitcoin. Bitcoin's taking that mantle away from credit-based money into commodity-based money because of this new environment. That's the piece I add to Jeff Schneider's Eurodollar stuff. But George is coming around, and I thought it was interesting. So that's my intro, long intro.
Amazing. Now let's get to the part where I piss everyone off. What's amazing is the Keynesians repeat this. The monetarists repeat this.
Okay, they repeat that the Fed is in charge. And this quote here is that this lady says, oh, the Fed is going to overshoot and cause an unnecessary recession. But he's saying the Fed doesn't do anything. Okay.
Amazing. Now let's get to the part where I piss everyone off. What's amazing is the Keynesians repeat this. The monetarists repeat this. The Austrians repeat this. But let's go back and look at these top 3 myths and see if there's any validity to this argument. Or at the very least, I'm not saying that I know all the facts, I know all the truth, but I do know when something doesn't pass the sniff test based on the data, based on the charts. So at the very least, what I'm saying is we have to start questioning this. We have to. This is not the sacred cow that we can't scratch our head and say, well, maybe we should take a different approach. Maybe this isn't true. Maybe what we have been led to believe is inaccurate.
Oh man, I feel his frustration and his struggle, because this is my battle over the last 5 years, trying to get people to see this, and they won't. They won't. Jeff Schneider, I asked him, how to fix this and stuff. And he's like, well, first is education and getting people to wake up and see this problem, see the system as it is. And yeah, that's very, very frustrating. And I feel George's pain here.
We've got to start looking at the things that we have been told over and over and over and over again. And to the point where they don't even need facts to back them up. and we have to start trying to poke holes in this stuff. This is how we progress. This is why they say science, or I would argue economics, advances one funeral at a time. Because once that generation is gone, then finally you can start asking questions. Finally, you can start looking at the data objectively, and then you can have a good, respectful, intelligent debate and start advancing the thought forward and really get to the truth. Okay, so first,
really, economic thought has been stagnant for 40 years, roughly. There hasn't been a lot of original thinking. I would go back to like Hayek and Friedman, and maybe you could put Rothbard in there. At least Rothbard, I view Rothbard more as a historian, but I would say Hayek and Friedman were more on the theory side of things, and that was the last. Those two were the last greats. Economics has been stagnant.
myth: the Fed controls the money supply. So let's.
Satoshi. Yeah, forgot to throw Satoshi in there. Okay, so he's talking about the myth of Fed controlling the money supply.
Let's go back to Twitter. Or let's go to Twitter. And I'm just going to reference a tweet here because this was on Zero Hedge the other day. And it was from a gold guy. I don't want to throw anyone under the bus here. So I'm assuming a guy he uses a lot of the words the Austrians use. So let's just read this little bit here. The casual use of the word weapon is apt in the hands of the state monopoly. So you hear this from Austrians all the time. The state monopoly on money. So he says, in the hands of the state monopoly, money can indeed be weaponized. Inflation is the artificial expansion of money and credit that has the effect of transforming wealth from money holders to inflators. This has been done under the guise of policy, appearing official, orderly, legitimate, but involves elites in power taking action that would otherwise be criminal behavior. So what he's referencing here is the Fed, the government, they're printing money, they're printing money, they're printing money. The Fed is control, or if they're not, they're controlling the banking system. They're creating more of this. And hey, my favorite economist of all time, Milton Friedman, but he wasn't right on everything. One thing he got completely wrong was he looked at bank reserves as what he called high-powered money. So Friedman would sit there and he would argue for the multiplier effect. Well, as the Fed increases the amount of bank reserves, in other words, high-powered money, well, then that increases the balance sheet capacity for the banking system, and therefore they can go ahead and create loans that they otherwise could not have created. So this is the argument here. Well, the Fed is going to expand their balance sheet, and yes, it's true. They're not directly impacting, or they might not directly impact M2 money supply, but the banks will go ahead and extend those loans. And even if the banks don't need the bank reserves, well, then the Fed is going to drop rates artificially low, and then the banks are going to be able to extend more loans than they otherwise would have, and therefore you have more money creation, more fiduciary media. And then even if it's not a result of Fed funds rate, the overnight rate, let's say, well, then it's a result of QE, because QE is bringing down the long end of the curve, and therefore mortgages are cheaper than they otherwise would have been, and you have more credit creation. This is the argument against what I'm saying. So, George, you know what you're talking about.
I mean, that last part is probably true. Lower interest rates create more mortgages. I mean, just look at what's happening right now. Is higher interest rates are creating a thing where there's not a lot of homes being bought and sold, and the ones that are, a lot of them are cash buyers. But that goes to asset price inflation. So asset price inflation is a real phenomenon, but it's that credit creation is narrowed to those asset classes. Not that credit is expanding necessarily at a faster rate, or that it's stuck in the banking system or something. No, the credit creation is narrowed to less risky activities, which housing is seen as that because it typically goes higher. There are housing crises, but those are less common those are the exception.
About, because everything still goes back to the Fed. It goes back to the Fed's balance sheet, or it goes back to the Fed keeping interest rates artificially low. That's the argument. Well, let's see if it holds up when you look at the data. So now we go over to bank reserves. Let's start with the first, that the Fed controls the money supply, or the government or whatever. The central planners control the money supply. Okay, so if this is true, then you should see a direct correlation between the bank reserves on the Fed's balance sheet and global, not just US, but global dollar money supply. But we'll just focus on the US. So the Fed's balance sheet, and let's look at pre-QE, because it's not like this argument started with QE. So we go to 1980, and I'm just using this time frame because it's just so blatantly obvious that we've got right here, 1980, we've got 42 billion in reserves.
I'll make a comment about his starting point here in 1980. This is, the Fed's policy up until Volcker, really 82, was targeting monetary aggregates. So they were targeting the money supply, M1 or M2, and they would fudge with reserves to target the money supply because they correctly thought inflation was a money supply thing, not a prices thing. And so anyway, they were targeting money. Then in 82, it shifted towards this Volcker myth of using interest rates as a way to combat price changes. And so completely different school of thought here at the beginning, and he's talking 1980 to even 82. They totally changed their school of thought on monetary policy.
You fast forward to 2007, we have what? That would be 42 billion in reserves. The Fed during this time, and you say it went up and down. Basically, it's on net, pretty much identical. Nothing really changed. So the Fed did nothing from 1980 to 2007. And you can take it even further back. I mean, let's go back to look at right here, 1975. We're almost at 40. So from 1975 to 2007, the Fed basically did nothing. Zip, nada. You say, oh, well, they manipulated interest rates. Did they?
Okay, so his argument here is that reserves added to the system is like money printing, and it creates a compounding effect through fractional reserve banking. And if you up the reserves in the system, then the banks can pyramid scheme on top of that. But what he's showing is that's not the case, because reserves pretty much pre-GFC were always flat. They were relatively flat. I mean, if you look at this bottom part where the time frame that he has in here, you can see it's basically nothing until the Great Financial Crisis, and then it jumps up. Okay, then it becomes something. But reserves, they don't mean anything towards money printing or the amount of money in the system at all. That's what he's pointing to.
How did they manipulate interest rates without doing anything in market operations? Weird.
Well, in 75, they weren't targeting interest rates.
See, because the argument there is if they want to lower interest rates, they're going to buy bonds, create bank reserves, and therefore interbank lending is going to have more cash. And the more cash, more supply you have, then of course, what happens? Well, you have more supply, and then the interest rate is going to go down, as the theory goes. But you notice that they raised and lowered interest rates with really not having to do much at all to open market operations. In fact, they did the opposite. When they were raising interest rates, they were increasing the amount of reserves.
This is a great point. This is a great point. Well, let me just listen to that one more time.
Interbank lending is going to have more cash. And the more cash, the more supply you have, then of course, what happens? Well, you have more supply, and then the interest rate is going to go down, as the theory goes. But you noticed they raised and lowered interest rates with really not having to do much at all to open market operations. In fact, they did the opposite.
Yeah, if you go to back and look at like moving of the interest rates, Alan Greenspan or I guess Volcker before, and you look at when they moved the interest rates, they didn't really do anything. The FOMC, the open market operations, that desk might have done some like notional things, like these little bumps that you're seeing here, but they really didn't do anything open market operations wise to change the Fed funds range. So how did it change? Psychological, baby. They talked it, they jawboned it down. They didn't do anything mechanically. That's what I've been saying for years. They don't do anything mechanically.
When they were raising interest rates, they were increasing the amount of reserves. If the open market operation argument that we're led to believe is true, if that's accurate, then they would have been reducing the amount of bank reserves. Because if you're reducing the amount of bank reserves available, and if banks actually used bank reserves, then what would happen to the interest rate? It would go up. But they're increasing the amount of bank reserves. Everything that you've been told about the Fed is
the reason why there is because the reserves going up supposedly affects the amount or the willingness of the banks to lend. And when you have more money to lend, then your interest rate goes down, everything else equal. So you would expect when the interest rates are going higher that the reserves should be going lower, but they're not. They're actually, and so the available money is getting tighter, but that's not the case. It's actually the available money is going up with interest rates.
Is not just incorrect. It's the opposite of the truth. But let's focus on 80 to 2007. So during this time frame, people are going to tell you that the Fed created inflation, that they increased the money supply, that they increased credit, that they increased all these things, but they never look at the Fed's balance sheet to determine if they even did anything. Because when you look at the Fed balance, you see that they did zero. They did zero.
This is part of the argument too of we wanted to audit the Fed because people thought that there was some funny business going on because they weren't increasing reserves, but that couldn't be the case if the inflation was at X, Y, or Z, or rates were at X, Y, or Z. To move the rates around, you needed to actually do some open market operations. So they said we need to audit the Fed to find out exactly what they're doing because their official numbers aren't showing anything. They instead of that, they should have questioned their assumptions in the first place and said, wait a second, the Fed's not doing anything. Do I understand this correctly? That's the light bulb moment that you have to do. And the reason why I think I was able to do that sooner than others was because I had questioned my assumptions with Bitcoin. So I was a gold bug Austrian. I came into Bitcoin and I had to completely question all my gold and silver talking points, all my gold and silver assumptions that I had, all the Austrian assumptions of the regression theorem, all of these things. I had to question all that. So I was able to do that, or at least I understood how that felt and how that would go. And then when I started in 2018, started coming across this stuff, I was able to question my assumptions again more easily than other people because I had just done it for Bitcoin 4 years earlier. So it's amazing that George has gotten to the point that he has, because most people, they can't do this. They cannot question those assumptions.
Now, we're going to get into interest rates in just a moment. That's the next fallacy. So if you're sitting there pounding the table saying, well, George, they didn't do anything with reserves, but they kept interest rates artificially low, which led to more bank credit being extended. We'll get to that in just a moment. But one thing that my good friend Bob Murphy went over, and I want to address that, is, let's see if we can find it. I think it's the comments. This is the desktop. There we go. There we go. So Bob brings up base money, which you can see increases. The problem with bringing up base money, and I go over this, in my response to Bob, is that it includes currency in circulation. So currency in circulation has nothing to do with the banking system, because any cash that the banks would have would be included in their reserves. That's in the reserve metric of 40 billion. And by the way, that's vault cash. So how are they settling with vault cash? They're most likely not, which means that my point is even more extreme. So let's just go back to the reserves. What I'm saying here, just to make sure everyone's following, is right here, you had 40 billion in reserves. Right here, you had 40 billion in reserves. But the argument is that this expands the balance sheet capacity for the banking system so they can lend more because they have more reserves for interbank settlement. So they can create that loan, they can transfer that deposit liability to another bank, and then they have the reserves to go ahead and transfer the offsetting asset. so they can go ahead and make that mortgage when they otherwise couldn't, right? Okay, but what we have to do is we have to look at the amount of these reserves that are actually able to be utilized for interbank settlements. Now, I'm sure that vault cash could be used, A, if it's held at the Fed, or B, if they just take it in a massive Brinks truck and just, JP Morgan sends $1 billion or something like that in the Brinks truck over to Wells Fargo. But realistically, especially when we get to 2007, that's not
They're all on Wall Street, right?
the way it's working. The only thing that they would really use for interbank settlement would be electronic reserves. So if you break down this 40 billion right here in 2007, only 8 or 9 billion was electronic. The other 32, 31 was vault cash. So you had 7.5 trillion in M2 money supply just in the United States, probably 50 plus trillion outside of the United States, with 8 billion in electronic bank reserves that could actually be used for settlement. And you're sitting there telling me that the banking system used bank reserves? Of course they didn't. Of course they didn't. So if the banking system didn't use bank reserves, and it's blatantly obvious through this time period, then why would they be using bank reserves now? Because the argument's going to be, well, it's a lot different now with QE. Why? If they didn't use it back then, why would they use it now? There had to be some element, some component of the transaction that where they got the Fed involved, their balance sheet, it made it cost prohibitive, or it skewed the risk and reward for the transaction. It added an additional cost. So if it added an additional cost that would prompt them to just settle interbank without even the Fed's balance sheet, why is that somehow changed now? Of course not. Of course not. So regardless of what your position on the Fed being at the center of the monetary system, you have to at least acknowledge this and explain how global dollar M2 can go up to 30, 40, 50 trillion while the number of bank reserves, electronic bank reserves used for settlement, actually went down. The only way that can happen is if the monetary system is functioning completely divorced from the Fed's balance sheet.
There you go. That's the kicker. The banking system is independent of the Fed, and the Fed can't really do anything. And the Fed knows it. If you go back here and read their minutes from 1980s, which I responded to one of George's tweets today, and I included some minutes from Volcker in the 80s. They're frustrated because they don't do anything. They don't know. They don't have a steering wheel. They don't know what they're doing because nothing is working. And this is when they start targeting M2 or M3. They say, oh, maybe monetary aggregate, we need to change that to M3. Of course, that didn't work either. And so then by 1982, they're starting to be like, okay, we need to just do interest rates. That's our steering wheel. Even though it's not real steering wheel, it's a play steering wheel, but they use it as if it's real so that the economy thinks that it's real. So that they were frustrated like this, and they knew that it was divorced from the banking system, and the banking system was independent. You can call it the shadow banking system. That's what I like to call it. Jeff would call it the Eurodollar system, but this is completely independent of Fed actions other than psychological operations.
All right, now let's move on to the next one. Because the argument here is going to be the Fed keeps rates artificially low. Even if they're not manipulating the money supply with the balance sheet, they're doing it with artificially low interest rates. I mean, the first question I would ask there is, well, really, how are they lowering rates if they're not using their balance sheet? Think about this. Rates right here in 1980 were called 18%.
Yeah.
Overnight Fed funds. We fast forward to 2007, and they're maybe, 5%? So how did rates go from 18% all the way down to 5%, while M2 goes from 1.5 trillion up to 7.5 trillion in the domestic economy without the Fed doing anything to the amount of bank reserves if they control the interest rates through the amount of bank reserves?
These are just questions that you can't answer unless you completely start from going back to basics. You hear a lot about, in the Austrian school, they talk about reasoning from first principles. Okay, well, if this destroys the principles that you started from, those principles were assumptions, and you need to question those assumptions.
You see, none of it makes sense. None of it makes sense. But everyone thinks this is just the way it works, and it's written on stones, brought down by Moses from Mount Sinai, just because it's just said over and over and over and over again. How many of you on this live stream right now, if I said, oh, well, the Fed...
And Bitcoiners are very guilty of this. They are hook, line, and sinker bought into this whole fiat paradigm. It's all fiat, even though it's not fiat, it's credit. But they are totally bought into this. So for 5 years, I've been yelling into the wind to try to get this realization across to people. And a lot of you guys in here watching this, you have joined me on this journey. And hopefully this starts to sink into people. And yeah.
Fed, the Fed has just printed too much money, or the Fed just caused too much inflation. You just say, oh, yeah, obviously. Or if I said, oh my gosh, well, during Greenspan and everything, the Fed just kept interest rates artificially low. And that's why we got the housing market bubble. How many of you would say, oh yeah, of course, obviously. We're all guilty of it. I was guilty of it when I first started this channel. But what happens is you start doing thousands of whiteboard videos and you start trying to explain this to the best of your ability. And you're like, wait a minute, I actually can't explain this because when I look at the facts, it doesn't add up. Let's get on to the next myth, artificially low interest rates.
So what's the solution? Okay, so it doesn't add up. I'll let him go on to the interest rates here, which is a very good one. And I've covered this in the interest rate fallacy blog post. But the answer is that the system is evolving and moving and living and breathing all on its own. All on its own. That central planning doesn't work. Not that it doesn't work, but that central planning is a myth. It doesn't really exist. Like I say, in short periods, 1 year, maybe 2 years, you can have a big bump, like say the government does 10 trillion in stimulus, deficit spending over a 1 year period or something. You're going to have major effects from that in the economy. But you're not going to be able to centrally plan how that turns out. Okay, so central planning is a myth. And the economy is alive. It's breathing. It's a living, breathing entity that is evolving naturally. And the money that it chooses, the tool that it uses, because money is just a tool, right? The tool that it uses is going to change depending on the environment that this living, breathing organism of the market finds itself in.
Here's a chart of the spread between the 3 month, which is, well, obviously it's not the 1 month, but it's close to a rate that would be impacted by the Fed increasing or lowering the overnight rate, FFR, Fed funds rate. So what we want to do is we want to compare that to what's happening with the 10-year Treasury yield, which is much more market driven. Because if the Fed had interest rates artificially low, then what that means is
and he says it's more market driven because really longer term interest rates are the market's view of future growth and inflation expectations. And so it is much more driven by the market. Alan Greenspan started trying to explain how the yield curve worked. And he was just like, oh, it's just a series of 1 year forwards. Okay, so the 1 year to the 2 year to the, I think there is a 3 year now, 5 year, 10 year, so 7 year, 10 year, 20, 30. It's just a series of 1 year projections. And so if that's the case, there should be no period in time where there's an inversion, because negative interest rates don't really make sense in that world. So since there is an inversion, that thinking has to be wrong. It's not a series of 1 year forwards. It is completely different. The short end is driven by Fed expectations, the psychological programming of the Fed and Fed statements of policy and stuff. The long end is not controlled by the Fed. It is inflation and growth expectations.
you would see a huge spread because the 10-year Treasury yield, let's just say hypothetically, is at 10%. And if the Fed funds is at 0%, then what the market is telling you is that interest rates are way, 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 way too low at the front end of the curve.
Okay, so there was, I kind of messed that up with my pauses, but okay, so if the rates were artificially low, we would see that in the front end of the curve, not the back end of the curve. So we would see that the 3-month is artificially low, and it's way below the 10-year. Because if the real market rate was higher, that will show up in the 10-year. Okay. And artificially low, setting policy artificially low would mean that the 3-month is way low compared to the 10-year. But that's the opposite of what we see. Okay. And he's going to go into that.
If the delta between the two is typically, let's just say 3%. So we can go back, and I'm just going back to this chart. Actually, let me do a max here to make sure we're going. Yeah, this is a max chart. So this goes back to the 1980s, but just, have some fun with it and do some research this weekend and go back to short-term rates and long-term rates in the 1800s when we didn't even have the Fed and see what the delta was back then. If you want to get an average, or what the market force, the free market, would actually produce. But for the sake of this example, let's assume that this average is what we would see in the 1800s, which I'll bet you it's darn close here. But let's say that the delta is usually 2%. Okay, so again, if interest rates were way too low, then you would see this spread blowing out. You would see the spread at 5%, 6%, 7%. And you say, well, George, there's times here when it's definitely higher than 2%, if that's the average. I'd agree. Absolutely, of course. But there's also times, and I would argue the majority of time, especially recently, that it's less than 2%. So if it's less than 2%, what that's telling you is that the Fed doesn't have interest rates artificially low. They've got interest rates artificially high.
Boom. That is the kicker on this point. I never even thought about it in those terms. But yes, if we have a low spread on the 3-month or 10-year, the 10-2 spread or the 10-3-month spread, and we're down here very low, that's because the interest rates are artificially high. The 3-month is artificially high. And that spread is not able, the free market does not create the spread, because remember, the market is in charge of the 10-year yield. A fascinating point by George here.
Think about it. Every single time we go into a recession, let's see if I can pull up Fed funds. I think I've got that on Twitter. Here we go. Yeah. So every single time we go into a recession, what does the Fed do? Well, you guys know this. They drop rates. But what has preceded every single recession going back to the 1950s, the 1960s? An inverted yield curve, which means that long-term rates are lower than short-term interest rates, specifically the Fed funds overnight rate. So if the 10-year Treasury is here and the Fed funds rate is here, how is that artificially low? That's artificially high.
Okay, there's a problem with his argument here. That's because, remember, the Fed didn't start targeting interest rates until 1982. So going back to the 50s or 60s, and you saw a yield curve inversion, that wasn't because of Fed policy. That's the way the market works. It would go more into longer dated stuff because the shorter dated stuff was seen as too risky.
By definition, just looking at the bond market, the part of the bond market that that the Fed has the least impact on. So the free market, let's say, the free market forces there are telling you that the Fed has interest rates artificially high, not artificially low. So when the Fed drops those rates to a point, let's say the 10-year is trading at 5%, and it drops down to 3%, and then the Fed has dropped rates down to 1%. And everyone says, well, that means that they're artificially low. No. The market is telling you that that's probably where short-term rates would be without the central bank. That's where the market would place them based on the yield of the 2-year and the 10-year.
Okay, this is not really the case. I'll have to think about this some more, but because, like I just said there, if you go back to the 50s, 60s, and there's a yield curve inversion, there was no interest rate policy at that time. So there wouldn't be any artificial there. So there are periods in the free market where a yield curve inversion would occur. And so it wouldn't necessarily be artificially high or artificially low. But if you were to believe in artificially low, it doesn't stand up. Following the artificially low reasoning makes you have to believe it's artificially high, not low. So where did you get the artificially low? It was just concocted out of people's minds because they believe in a malevolent Fed, that they're the bad guys, that they're evil, okay, that they're doing artificial things. But if you think that, then even following your own reasoning, you have to come to the conclusion that it's artificially high, not artificially low. Now, in my case, I wouldn't believe either one. I would say the market moves the way the market moves, and that's it. Now, in this period right now, there can be some psychological operations. There's very little mechanical that the Fed does. So it all has to be psychological of the way that they are doing their monetary policy that could create artificial conditions. But overall, the market does what the market does, and the Fed doesn't do anything.
Which is what we're using specifically in this example, obviously. So, and then you say, well, my gosh, George, interest rates were 0%. Okay, fine. What was the 10-year Treasury yield? So we go over to this chart, and we got 10-year Treasury yield. Okay, the 10-year Treasury yield when they had rates at 0 was what? Let's just call it 2%. So
okay, this brings up the interest rate fallacy. The interest rate fallacy is that when rates are low, like this, the 10-year down here at 1.5%, 2%, means that financial conditions are extremely tight, not extremely loose. Because if there were someplace else to put your money to get a return, you would do that. Like if there were relatively good bets out there in the private economy, you would be putting it out there and getting 5% instead of holding a 10-year Treasury at 2%. But the fact that there's high risk, and the risk premium is up there, that no, you're better off staying at the low risk 2% than the high risk 4, 5, 6%. So bad economy creates low interest rates because there's no place else to invest your money. All right. That is the interest rate fallacy. Most people think high interest rates create tightness, but it's actually low interest rates that are the product of tightness. It's the complete and utter opposite of the what's common knowledge today, quote unquote common knowledge, is completely backwards.
let's go to the spread, or back to the spread of the 3-month and the 10-year. What's the average? Close to 2%. And if you go back to the 1800s, likely pretty close to 2%. So now the market might not.
Okay, and here's that number 2% again. I talked about the inflation rate of gold being 1 to 2%, and now the interest rate policy, or the inflation target is 2%, and now this spread between short and long term is about 2%. So all this 2% is kind of coming up in different things naturally in the market.
Have put rates at 0, but it would have been darn close. Maybe 25 basis points, 10 basis points. And at the end of the day, is that really those 10 basis points? Is that really going to move the needle? So I'm not sitting here arguing that the Fed nails interest rates every single time. No. But the evidence would lead you to believe that the highest probability was that the Fed had interest rates artificially high, not artificially.
There you go. That's what I was saying, that if you believe in this artificial power of the Fed, then your own reasoning would have to make you conclude that it's artificially high, not artificially
low for the majority of the time, just in this time series going back to, let's call it 1980. That was myth number 2. Myth number 3.
All right, he's getting to the end here.
QE. Well, if the Fed wasn't artificially dropping rates, then how do you explain QE? Because they're buying all of these bonds from 2008. They're doing QE1, QE2, QE3. And obviously, when they're creating all of this additional demand, for bonds, then that's going to be dropping the long end of the yield curve, George. So even by looking at the spread, it's completely ridiculous because the spread itself is being manipulated by the Fed. So if the Fed wasn't buying the long end of the curve, the spread probably would have blown out, which would have given you that signal that the interest rates were artificially low. So the fact that the Fed had their finger on the long end of the curve by doing QE, this defeats your entire argument. That would be the pushback. Again, making the same mistake. It's just hearing this over and over and over and over and over and over and over again to the point where you don't even question it. And you just assume that it has to be true. Because
this upcoming chart is one that blew people's... I showed something almost identical to this going back maybe 4 or 5 years. And this blows people's minds. This next chart seals the deal.
So many smart people out there have said the exact same thing, that it's not even worth looking up. But what's interesting is if you actually look at a chart of the 10-year Treasury yield and you compare that to QE1, QE2, QE3, and oh, by the way, when they stop doing QE, you see the opposite. The exact opposite once again.
Okay, so looking at this chart, the common understanding is that QE would push down long-term rates because it's adding a bid. Higher demand for roughly the same amount of treasuries should cause prices to rise, which are yields going down. But what do we see? During QE, yields actually increase. So the argument that QE is limiting that spread that he was just talking about between the long and short term, is completely wrong, because rates actually rise during QE. And they fall once they stop QE. See, between QE1 and QE2, they actually fall when QE stops. Why? Because this is a sugar rush, kind of, or people are thinking that it's going to work. They're giving the benefit of that, especially during QE1. People thought this was just unhinged stimulus. Oh my God, you're going to ruin the dollar. This is just crazy amounts of stimulus. This is going to destroy the financial system, destroy the dollar. It's going to be hyperinflation. And so that was the reaction. Huge amounts of inflation and growth was the expectation. And so it shot up. Rates shot up despite the Fed buying everything. Buying, it's really asset swap, but rates went up. And then as soon as they stopped, oh, now the bad demons come back, people's doubts and the bankers' doubts, and rates fall, because rates fall as money is getting tight. Rates fall as the economy is deteriorating. Then what happens? QE2, oh, maybe we'll give it another shot, but it never got back up to the previous level because it's a second sugar rush, diminishing marginal returns on things. And it ended QE2 higher than it started, but not at the top and not at it never got up to what QE1 got up to. So that sugar rush didn't work. But what happened when they stopped it? Boom, it dropped again. The old demons came back, the bad economy, people thinking that, this is money is going to be getting tighter, and so yields drop. Then we had Operation Twist. Nothing really happened. That's where they swapped out shorter term like bills that they had for longer term treasuries, and that did actually put a little bit of thumb on the price. But then QE3 started, or on the yields. Then QE3 started, and what happened? Yields went way back higher again. So this is the exact opposite of what people would say if they're trying to convince you that QE forces yields down. QE does not force yields down. QE forces yields up. Because if it does have some stimulating effect, yields will rise. Yields rise in good times. Why do yields rise in good times? Because people can afford a higher interest rate. People are more credit worthy. If everybody's making money hand over fist and the economy is on fire, then the bank is going to give everyone a loan because they're going to get paid back. Everyone's credit worthy. And they can afford a higher interest rate. So interest rates climb. But in bad times, the banks don't know if you're going to pay back the loan. And so they don't even give it to you in the first place. Fewer and fewer people are credit worthy. Fewer and fewer loans go out there. Only the highest credit worthy individuals are able to get loans, or the highest credit worthy use cases, which would be buying a home, maybe having margin hedge funds trading on the stock exchange, stock buybacks, whatever. All of these put asset price inflation, put at the prices of assets higher while the economy is deteriorating, okay, and yields fall.
Now, first I'd point out the trend, even before QE, was down. So you'd have to argue why the trend would have somehow changed.
That's a good point too. During the Great Financial Crisis was kind of like a breaking of the straw that broke the camel's back. But this is a multi-year, multi-decade long process that if you go back to 1980 to today, it's like pretty much straight down for these yields. So this is the deterioration of the economy, the deterioration of the credit-based system, the deterioration of the trust, deterioration of the demographics, deterioration of everything. That is what that 10-year yield going down. And actually, let's just bring that up. We will go to a monthly chart so we can see this better. And put it on a line, share this tab, and we will. All right, so if we just hide these drawings, I don't know why I have those lines on there, and put it in normal, it's logarithmic. Okay, so from 1980 to today, this whole thing is deterioration. This right here, after COVID and the response to COVID, this was a sugar rush off of massive government spending. But what happens? Government spending is pulling demand forward from the future. And I remember saying this back during COVID on the podcast, that if you're pulling demand from the future, there's a gaping hole of demand in the future now. And that's a recession just waiting to get run into. That's a pothole that's going to cause a flat tire in the future that you just created. Now, how do you fill in that pothole? You pull more forward from the further future. You borrow more money. And so Biden got in, and Biden and Yellen were bragging about cutting the deficit by 1.7 trillion, I think back in 2021. And I said, this is a huge mistake. They're not going to be very happy about this in coming years, because by cutting the deficit, you're not filling in that pothole. You're just letting the economy run right into it. And so what did they do in subsequent years? They started spending a lot more, the huge deficit spending that we have today. They finally realized that they need to do that because they need to constantly be increasing the amount of money that they're pulling forward to constantly be filling in the potholes of what they create by doing that. But that was the massive spending that actually gave this a little boost. But I don't think that's, this is not the end of the story. What's going to happen? Most likely, this is going to return back to down here. The deterioration is going to continue. The deterioration is going to continue until we change the system, until we change the form of money. What we have in the future is low growth, low inflation, grinding economy, high income inequality, until we change the system. And that will come when we go back to commodity money, like I was talking about earlier in the episode here. But okay, let's get back to George. I think he's pretty much done.
Once we went through a global recession called the GFC. And so I don't know why that trend would have changed to the upside, but I want to point that out first and foremost. But let's just look at the time frame when they did QE. So what did interest rates do with the 10-year Treasury yield at the long end of the curve when they did QE1? Well, they actually went up, not down. How about QE2? They went up, not down. How about QE3? Up, not down. And notice what happens when they stop doing QE. What happens to rates? That's when they crash. That's when rates crash. So it is true that if you move into QE4, and I believe it's 2020 or so, probably during the cerveza sickness, if you look at QE and interest rates, they did drop. But you've got one time when they dropped, and 3 times when they didn't drop, and several times when they stopped doing QE.
Okay, well, let's do that. Let's see if we can do that. Okay, going back to this chart. So this is 2008, and I'm going to do an arrow here. 2008. Oh, I already had an arrow there. That's what it was for, but I want it white. And let's see if this is a divergence. Probably is. Probably not here. Probably on a weekly or something. But anyway. Okay, so I don't know what to do. I'm going to delete this. Or hide it. And hide this one. Sorry, guys. We get to the content in a second. But okay, so 2018, this is what I'm watching. One of the things that made me question my assumptions is we didn't get any sort of inflation. We didn't get any spike here. We actually got deterioration of these rates into September. Remember September? That was the repo rumble back in September of 2019. Come on, this chart is slow. But September of 2019 was the repo rumble. Got a little boost there because what did they do? They brought QE back. Okay, then this QE fell. And we did massive QE here in March of 2020. And it still kind of fell there. But then it really raced up with all the stimulus and stuff from the government. So this is that period he's probably talking about. From the repo rumble to through COVID, it did fall. But that was, you know, a unique circumstance right there. And they were behind the 8 ball already. And then we had this huge, big stimulus from the government. Okay, let's get back to Georgie.
And they actually started to go back down. And you know what would be interesting is if we looked at QT, and for some reason they don't have that on this chart because it stopped at 14. But if we look QT, I'd be willing to bet that when they did that, rates didn't go up, they went down. And it's pretty much the same thing. Well, let's do this. Let's look at the 10-year Treasury yield. And let's zoom in on the last 5 years. And then let's look at the Fed's balance sheet.
He can add it. He can add it to the same chart.
Okay, so they started doing QT in, call it June 2022. And since that time, they have done $1.7 trillion in QT. So, I mean, obviously, by selling this many, I mean, the long end of the curve must have just exploded higher. The 10-year Treasury yield must be, I mean, what, 5% higher than it was in 2022? I mean, that's a lot of QT. And if the Fed is obviously at the center of the monetary universe, and obviously they control interest rates, because when they do, see, so we've got 10-year Treasury yield. We go from, let's just be generous here and go back to June. So we're at 3.33. And today, after 1.7 trillion in QT, we are at 4.28. 90 basis points. And oh, by the way,
it's threatening to go lower. So you can see we did not go back to the swing high. Let's go to this chart. And we'll go to the weekly. The swing high here did not reach this level. And so, this is a weak position looking like it's breaking lower. And we should expect it to go lower if we're going into recession. So 1.7 trillion in QE, and rates are about to drop like a rock.
There's been times right here after they've done, let's say, $1.5 trillion in QT, where interest rates on the 10-year were down in the 3.7 range, 3.7 range. So where would we have to go back to find 3.7 that we had in December of 2023? Well, we go back to, let's say, October of 2022. So October 2022 to December 2023.
All right. What he's going to do here is just measure it out. There's really no effect from QT either, just like there's no effect, as you would expect, from QE. But that is going to wrap it up for today. I did have one comment here on Telegram. What's up, Dex Invictus? Telegram is from Facey McFace. Asked, did I see the recent Bitcoin vid from Jeff Schneider, Death of the Dollar Narrative, Analysis and Critique of Bitcoin? I think I started watching, was that from like maybe 2 weeks ago? I think I started watching the first 5 minutes of it or so, or listening to it when I was driving, but I did not get through it. I'll have to do that, update my knowledge of what Jeff Schneider's thinking. All right, guys. Well, like, comment, subscribe, share. Bitcoinandmarkets.com. Check it out. There's free tier just to get the free weekly newsletter. That also helps me keep in contact with you guys if my YouTube channel gets deleted again or whatever the case is. And if you would like to support my content, you can do so on there as well. $5 per month is the member cost. You'll get blog posts early. You'll get the chance to be in the monthly price forecast competition and a chance to win $20 in sats every month. And then there's the premium level, which is where you get the protons and other content that I'm bringing over from Bitcoin Magazine Pro. So, all right, guys, that is going to do it for today. Thanks for joining me, and I'll see you on the next one.